My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the hour is Lakshman Achuthan, who I've had on a couple of these spaces in the past. What prompted this was a tweet where I'm pretty sure I cursed and said something about housing, as I typically do. And Locke replied to it. I figured, okay, you know what, this will be a good topic to get into. So, Lakshman, for those who are not familiar with you, just introduce yourself real quick to the audience. Who are you? What's your background? How'd you get involved in economics?
Yeah. Well, thank you. And whenever you curse, I pay attention. So
that's why I curse a lot on Twitter.
You curse a lot. But I'm the co-founder of the Economic Cycle Research Institute. Most people know us as ECRI, ECRI, and I've spent my entire professional career looking at economic cycles, studying economic cycles. And so it's from that cyclical perspective that I can kind of opine or add something to the debate with you today. You know, people think about cycles, they think about recessions and recoveries, overall economy, but there are a lot of different cycles that we look at. There's major sectors of the economy, and then there are separately cycles in inflation, and that's been a bit of a more hot topic over the last couple of years. And then within inflation, there's some very important price cycles, and the one you and I just linked up again on was home price cycles, housing. And there's also cycles that we track closely in commodities. It's another inflation cycle that we watch very closely. But today would be great to really drill in on housing, on home price cycles, on the construction sector, and what's going on there. And our strength is really around cycles. It's really around the odds, the probability, the chance, the risk of the cycle turning and going the other way. So, in the thought process, the way that people have a lot of different ways of approaching decision making, and they can have all kinds of scenarios that they're looking at or different models and whatnot. And the value add we have is that risk of a turn, of things, of the trend changing and going the other way. Because, you know, if you get surprised by that, it can be very disruptive. So that's really, and then when there's no turning point, it's good to go. You know that you don't have to worry about getting surprised by a turning point, and that's also very valuable information. So that's pretty much the piece of the puzzle that we add. We think it's an important piece of the puzzle.
All right. So in the paper that I put out, Lumber Worth Its Weight in Gold, one of the studies that was referenced in that research study around the predictive power of lumber when it comes to the stock market is the study by Lemur. He titled it "Housing is the Business Cycle." All right, and that's from 2007. Talk through to the audience how important housing historically has been to the economy, and what's unique about housing that makes it more of a leading indicator compared to other economic metrics that you might look at.
Yeah, so it's for most people, if you're lucky enough to get a house, it's going to be your biggest purchase. There's a lot of related activity around housing activity with different types of knock-on purchases and things that occur in the life cycle of construction of owning a home. Any of us who have been involved with a home know that. And it's also closely linked. It's very cyclical. It's not a kind of, it's a big ticket item, right? It's something that the circumstances have to be kind of right for it to be cycling up, or to be cycling down. It's very credit sensitive, supply sensitive. There's all kinds of issues. There's demographics in there. But it is a major driver. Housing, construction, major drivers of the overall business cycle. I don't think I'd go quite as far as Lemur in saying it is the business cycle. Nothing's that simple. But I would agree it is a key driver of overall economic cycles. And I think in the separate debate about hard landing, soft landing, no landing, all this stuff. Something that there's a lot of focus on the Fed, a lot of focus on consumption, as or employment, and these are some might argue in one way or another that they're saying soft landing or no landing or whatever. But I think a lot of people miss that it's the goods side of the economy. So that can be construction and goods, other goods, that are those. It's really cyclical. There's bigger cycles there, and so in contrast to the services side or the consumption side, which can at times be smoother, when you get a big swing on the goods side, and today we're talking about housing, construction stuff, those swings are so large at times you get the tail wagging the dog. So you have recessions can start. You can see them. They get triggered by the bigger swings in the goods sector, and then eventually the other parts like services may slow down or kind of flatten out. And that's enough to get you a recession. So I think understanding that is underneath this idea that housing is the business cycle, even though I think that's a little simplistic. And when you said about lumber, by the way, right? So that relates a little bit. That's another interesting point, but we can get into that if you want.
Yeah, no, I definitely want to do that, but I think also the other part of this is, you said it correctly. Obviously, housing is sensitive to credit, but it does actually create credit as well, right? It is a driver of credit creation and credit contraction.
Absolutely. It's and we've had a lot of kind of intervention in those markets over the last decade, post GFC. And maybe that era has come to an end, the QE era. We'll find out. But credit is a big piece of the cycle. Housing is a big piece of the cycle. Industrial stuff is a big piece of the cycle. Financial, other aspects of financial activity can drive the cycle. Global patterns can drive the cycle. So there's a lot of important drivers of the cycle. They're not unlimited, however, and that's something that has allowed us to develop international leading indicators, which are comparable to one another. There's a similarity among them, so they're meaningful to one another, and that helps us a lot when we're navigating the global economy, within which the U.S. has to. We get knocked around by that on occasion, and certainly now with a global downturn, that's a key issue for us. And I want to get to later in the conversation the fact that the home price downturn that's occurring here in the United States, that's happening around the world.
And I want to actually get directly to that because I'll share it at the top of the nest, the observation you have around China, and it makes sense, right? I mean, the boom in housing was largely obviously driven because of COVID, and that was a global phenomenon, right? So it stands to reason that it would all correlate in the same way on the downside. Historically, though, in other recessionary periods, in global slowdowns, do you tend to see sort of a coordination of declines in advance of like the bulk of recession when it comes to housing prices, not just in the U.S. but in other countries?
No, it's a little unusual. This is a nuanced point, but I think everybody listening can handle it. It's not rocket science. It's fairly straightforward. So there is no. It's hard to say there's a global business cycle. I think we can say with a great deal of evidence that there is a global industrial cycle, which is contracting right now. Then when you get to services and real estate stuff and housing, that's harder to see globally. In the sense, it doesn't tend to synchronize globally that often. You can really have asynchronous cycles in some domestic activity around services and construction and whatnot. And so sometimes some economies are doing better than other economies. We're not all synced up on that score. On manufacturing, we're more synced up. What is unusual, I guess it's part of the reason why we're probably more concerned about the global downturn than some, is that you do have this synchronized a lot of it's synchronized globally, and it's synchronized also in housing, which is, as we said at the top, is a key driver of the cycles. Generally speaking, right, the low rates of the past decade helped goose or support higher and higher home prices. And each economy may finance their housing differently. The U.S. is probably relatively well insulated to interest rate rises compared to some other economies. Some other economies have it a little rougher, the way that the mortgages reset. But the real standout has to be China, where we have leading home price indicators like we do for the U.S. And in that thread, that nest that we posted, there's a lot of information about the U.S. leading home price index, how it went up and down over the last couple of years. But in China, post GFC, so I'm talking post 07-09 recession, they really did, as listeners will recall, a lot of credit creation, which made its way into their housing market in a big way. In China, I mean, when I say in a big way, I'm kind of understating it. It's kind of off the charts in terms of credit creation there. In China, it's interesting because the household wealth is really concentrated, much more than in other countries, including the U.S., in home ownership and home prices. They're having China's just emerged from a recession, its first recession since 1989, which was Tiananmen Square, the last big protest there. And so they've popped out of recession as they've released the COVID lockdowns, but they've got this home price downturn, which is really, really wreaking havoc. And in the thread, we put up a map of Chinese home prices, and you can see the red areas are just pretty clear declines in home prices. I mean, the economy there is basically, until recently, it was in its worst shape in over 3 decades. The Chinese were just in no rush. They're just not interested in buying a home. And when home prices are going down, you're certainly not incentivized to buy home. You're more interested in waiting to see if the prices are going to go lower. And that's the part of the cycle they're in right now, which is kind of weighing very heavily on their prospects for activity. So they can emerge from recession, which they've done in a kind of mechanistic way, as the economy has opened up. But is there a nice cyclical impulse to the upside? No, it's not at all clear. And I think part of the culprit is households looking at most of their wealth in their homes, and those home prices declining, are not feeling particularly flush as a nation. And that's not over. So there'll be some policy pushes to kind of goose it a little bit, but there's a limit because of the size of the debt that they already have.
Which basically argues against the idea that all reopenings are the same economically, right? That what's happening with the China reopening is not going to be a repeat of us in late 2020, early 2021.
Yeah, I don't think in the same way. So there's a mechanistic opening, right? Just by virtue of opening the doors, activity pops like a coiled spring. But does it have follow through, right? A cyclical recovery is going to be pronounced, pervasive, and persistent. And in order to put that together, you have to get some kind of positive feedback loop, some positive confidence, access to some money, some pent up demand, some hiring, and it kind of goes in a loop. Here, we don't see that engine really revving just yet. I mean, China has changed over the past decade. It's not quite as export dependent as it was, but exports are still important. And we are in a global industrial contraction at the moment.
Let's go back to housing in the U.S. here.
Yeah.
So I think housing seems to be confounding from a lot of perspectives here. And we can argue it's because of inventory, but even when you look at market prices themselves, lumber has been unrelentingly weak since last year. Right, you had a bit of a surge to start the year, then round trip, now kind of coming back, noisy. Home builders have been very strong, right, which is inconsistent with a bear market, by the way. Then you have economic data like just came out, right? Pending home sales were quite strong in January, and everyone's expecting housing is going to keep on weakening, but the data seems to be at odds with that.
Right.
I'm curious to hear your thoughts on, is this a situation where people are wrong about the narrative around how the housing downturn fully plays out, or are there some other weird dynamics of this cycle that make it more challenging to figure out the sequence, the path?
Yes to a lot of that. Okay. So, but I think that the punchline is that it's still to the downside. There's no recovery that's going to be sustained in the housing sector for the time being. In 2020, right, we had a mass, like basically there's some sort of structural shift that seems to have occurred there. And we were talking about this in the middle of 2020. This is ancient history now, right? But you remember the lockdowns and everybody's like, what are we going to do? How does this work? What's going on? And we had indications about the shifting of where people were living with remote work and getting away from the urban centers to the city, to suburban cities, and how that may not be temporary. And when we looked at, regardless of that analysis of whatever was happening with the headlines and with the pandemic and that kind of thinking, we look to our leading indicators, which are objective, right? They don't read headlines. These are drivers of certain cycles. So the leading indicators of home price cycles were taking off in 2020, and really ramping up quite sharply towards the third quarter. And we were looking at kind of the biggest housing boom we were going to see was happening right there. A housing boom to rival that of the early 21st century was happening right then. But by February, right? So that everybody's running out and grabbing single family homes, basically, is what they're doing in the suburbs. But by February of 2021, right now we've gone forward about a half a year. Those forward-looking indicators, which had seen a surge in home prices, in real home prices, inflation adjusted, then you were seeing signs by early 21 that we kind of peaked out. I mean, that old adage, the cure for high prices is high prices. I mean, they had run up so crazily. It was starting to become just too much. And by the fall of 2021, right? Again, that's a long time ago. The downturn in that leading home price index was really starting to gain momentum at the same time. Okay. And this is a little tricky. I don't think people normally think this way because models typically can't think this way. But we can use indicators for cycles and inflation and then put that on hold and then switch over to indicators on cycles and growth. And when we look at the construction sector, not now we're not looking at home price inflation, but rather we're looking at construction activity. By 2022, we've got a very, very, I'm using three varies intentionally, sharp decline in the level of our leading residential construction indexes. And the coincident measure of construction activity was only starting to top out there. Now, this seems really out of step with some of the headlines, right? You've got construction employment at record lows. You say you have the home builders doing well, those stocks. I mean, there was definitely activity in multifamily stuff, and there were stories about backlogs in construction. But the forward-looking drivers of construction activity have just kind of fallen out of bed. And you can think, that is where the credit component of this starts to bite. And I think we're only starting to see that bite. And this is also happening actually in non-residential construction too. So there is a downturn in construction, residential, non-residential. There's a downturn in home price inflation. There's a downturn in the manufacturing sector, which is also a big part of the goods sector. All that's happening together. So when you get down to raw materials, right, like lumber or other sensitive industrial material prices, they're going to have a tough time delinking from that for very long.
I will note that point about the 2021 stalling coincides with the stalling of the Russell 2000 and small cap indices. Mm-hmm. Right? There is a link between housing activity and small caps, because small caps are more sensitive to the domestic economy, to the consumer, than multinational large caps. So typically, for example, when lumber does well, small caps will outperform large caps. When lumber does poorly, it's the opposite. So it is interesting that does kind of confirm and coincide with the historical testing on the relationship of housing to equities. Now, the other part of this is, speaking about just things being confusing, it seems very confusing to think that we could be in a recession, entering a recession, or already in one, whatever it is, when jobs are still seemingly quite strong. I know you've done some work on this. So explain to the audience why that narrative that you need to have job losses to really confirm a recession, why that's not true.
Well, no, I think actually I would make the point that you do need to have job losses to confirm a recession. At the start. Yeah. So if we're in, if there's a recession, we're going to have to show some negative jobs growth somewhere around that episode to confirm that it was a recession. Without that, it wasn't a recession. The extreme versions of this would be in the mid 70s. You had the 73, 75 recession begin, and then it took 8 months until you had job losses. And then in 1980, it took a couple of months until you had job losses. Now, some of this data also is subject to revision, so it's not immediately apparent where you are with the last data release that came out. Those are subject to change, right? But the thinking behind this is that during inflationary periods, managers can get distracted by the so-called money illusion, where top-line revenue growth is holding up, even though units and things like that, or you're selling less of stuff. And so it's not immediately apparent how profits or the profitability component is getting squeezed. And it takes a little while for that to become kind of in your face for managers. Quite separately, right? I think just let's just again reset. And I think we alluded to this at the beginning of the call. Post COVID, coming out of the extremes of that recession and recovery, there's still a lot of backwash going on. There's backwash in the housing market, and because of some of those structural shifts moving out of the cities into the suburbs, and then there's a lot of backwash that we're still working through in the jobs market. There's all the stories about why the labor force is smaller. It could be immigration, it could be aging, it could be taking care of people who are sick, it could be all kinds of things. But there's a lot of people who are out of the workforce, so the workforce is tighter. When you have a recovery as sharp as we did, and you can't hire people, you're very, very loath to let them go. so you have this so-called labor hoarding. So you have a combination, some overlapping of labor hoarding, where you're reluctant to let someone go who you finally hired 6 months ago, and this so-called money illusion. And just to make it a little more complicated, there's some statistical stuff and noise in the data with the big swings and how things get calculated in terms of seasonal stuff. So all of that is going on, and you have some hope that maybe there's a path to a soft landing or there's no landing as a result of jobs still being created. And you know the story, and everybody knows this. It's been part of the story for the last couple of months of that kind of hope that somehow we're going to get this kind of immaculate disinflation and everything's going to work out. And it typically just doesn't work that way. I mean, there's some things that are kind of typical. When I talk about being a student of the business cycle for my professional career, there's some typical stuff. One is that you know, it's a little odd for prices to come down dramatically without a recession or a very sharp slowdown. It's hard to have your cake and eat it too, right? If we are expecting a solid come down in inflation, and it's not a straight line, there's some backing and filling along the way. Yeah, it's kind of consistent with a serious slowdown, hard landing, something like that, whatever you want to call it. And the other thing is that the way recessions are typically kind of put together, the way that they get constructed, even though the stories are always different, is from the good side of the economy. And when you look at the more optimistic outlooks at the moment, it's like, hey, labor's holding up, the consumer's kind of holding up, services seem pretty busy. None of that is inconsistent with a recession, quite frankly.
And I think the other part of this is that you need to have some defaults, right? I mean, you need to have some default risk getting repriced into the bond market. You need to have companies going under, right? And we haven't seen any of that yet. Is the key word there?
Oh yeah. I think there's also this. Well, it's interesting, right? So I've just described kind of I've been giving you pieces of our kind of recessionary outlook and how it's built on the goods sector and the cyclical downturn there. None of that is predicated on the Fed doing sharp tightening last July or whatever, last summer. And pretty much everybody else's recession forecast is predicated on the Fed tightening, right? So if you could talk yourself into the Fed going on hold or slowing down or whatever they're doing, and sometimes you talk yourself into it and sometimes you talk yourself out of it, it changes your outlook for the cycle. And as far as we could tell, the impact of rate moves, policy moves by the Fed continue to have long and variable lags. They don't happen. They don't hit the economy that fast. They can hit the market quick, but they don't hit the economy that fast. It takes a while to propagate through the economy. There's a lot of knock-on effects. And when financing comes due and you've got to look at a higher financing number, sometimes things don't add up. And I think we're just starting to see that stuff. I mean, you could even argue in some respects it took a while to get until policy was even restrictive. So I'm not at all clear that the impact of the rate hikes has been felt yet. Our recession forecast wasn't built on the rate hikes themselves. And if anything, right, if the PMI comes in a little better than expected, if the jobs come in a little better than expected, if there's some sales report that's a little better than expected or whatever, all that adds up to central banks at home and abroad staying, probably staying tighter for longer. And my last chart, by the way, on that thread, quite separate from cycles, makes the case that it's a pretty big risk to assume that mission is accomplished just because inflation is cycling down. If the concern is in an inflationary kind of mindset taking hold, and so from the recent history, like the 1970s, where under different circumstances you had higher lows in the inflation cycle in between recessions. You just don't want to go there as a policymaker. It's pretty risky. So they probably err on the side of being overly restrictive.
I've been on this kick since the start of the year that I think there's a credit event out there, and when you look at a lot of loans that are on the corporate side, a lot of them are going to be there's going to be a wall that comes next year, right? I think some of the stats show that in terms of maturities between next year and the year after, you're talking about $1 trillion of corporate loans that need to be rolled over, but they're going to roll over into higher rates, presumably. Mm-hmm. Mm-hmm. So it seems likely that there's going to be a real risk that companies may not survive. The zombie companies will finally get put in the ground. Right? But the problem is if it starts to happen next year, presumably the market starts to anticipate that this year. Mm-hmm. So I'm curious to hear your thoughts on sort of that risk that based on those long and variable lags that the Fed could have already overdone it, and there's a real risk of sort of a mass default wave.
Well, look, that would be kind of par for the course of a recession. Right. So a recession, is the other thing, right? Having studied recessions, right? This is the focus. Not recessions. I've studied recoveries too, right? So recoveries are just as important, but the recession is not a bug. It's the feature. It's a feature of a market-oriented economy. It plays an important role, even though if you end up being the collateral damage, you're not very excited about it. It's an important function to have the zombies fail, right? It's an important function to have the defaults, because that prepares, that reallocates resources, that prepares the economy for another run of more sustainable or healthier growth. And so avoiding that, like any implication that a recession is like the end of the world and something to avoid, I think maybe that's even the trap we fell into. In not us, but policymakers and stuff after the Great Recession, they got so freaked out by that the idea of a recession became it was like Armageddon, that they would do anything, right? What did Draghi say? Anything, whatever it takes. When you repress interest rates like that, you lose a lot of your kind of nerve endings in the economy, and it's tough to price risk properly. You probably underprice risk at times, and these zombie companies are floating around, tons of capacity when you don't need it. So it depresses prices even further, and that's what we went through in the last 10 years. And so here, I mean, you can't rip the Band-Aid off without it stinging a little bit, but it's kind of getting back to a somewhat, that would be if you had more defaults, that would be a more normal functioning of a market-oriented economy. And I would expect that you would see that with a hard landing. I would expect you will see earnings growth continue to slide down or go negative. Those are normal things that occur during recessions. Another thing to keep in mind about kind of cyclical patterns. I've been clear that cycles in growth are separate from cycles in inflation. The lows in the inflation cycle are typically not reached until well after the end of a recession. So there's a lag there. you could have a recession kind of end and the recovery begin, and inflation is still cycling down. So I think what we're saying is some of this stuff also takes time. It doesn't. We can anticipate it today intellectually and say, oh, here are the sequences, but for them to actually pan out can take a bit more time. And then, of course, the stronger and circling back, I'm just engaging with Michael on lumber. Sensitive industrial materials prices are the ones that'll really swing, right? Those commodity prices can swing quite a bit more. We've been tracking commodity prices very, very closely since before I started in the 80s. My mentor helped put together something for some of the older listeners might remember the Journal of Commerce Industrial Price Index, which is a basket of sensitive industrial materials prices. And what's interesting, some of those are exchange traded, some of them are not, but they move together because they're so tied to actual activity. Every once in a while, the exchange traded stuff will diverge a little bit from the non-exchange traded stuff. We had a little bit of that happen earlier this year, right? There's like, oh, maybe there's a soft landing. Things are going to be okay. And the exchange rated, some of the exchange traded sensitive commodities started to ramp a little bit. But the non-exchange traded stuff didn't flinch. It just kept easing. And more recently, we've seen traded commodity prices start to slip again to kind of join back up with the non-exchange traded stuff. So that's an interesting thing to watch. And we keep a close eye on that, and it continues to cycle down. So just circling back, yeah, autos and housing, those kind of prices are definitely softening up. I think a lot of people focus on coincident data or short leading data, right? So whatever's going on with durable goods or autos or housing, that's all kind of now. That's the economy outside our window. So our coincident data will track that. You could look at production and employment and income and sales in those areas, and that's kind of telling you where you get a sense of where you are right now. And there's a lot of good in knowing where you are right now. I'm not saying that's unimportant. That's very important. But leading indicators will change direction before those indicators would. And so you would expect them to turn and be going in a different direction, even when durable goods, autos, and housing is still continuing whatever cycle it was in. So that's one distinction. I think there is a lot of conflating between leading and coincident data that makes things confusing. If you can be very diligent, which we are, in separating those out, things become a little bit clearer. The sequences become a little bit clearer. Now, to the point of the structural changes in the economy. So I had mentioned early on that we're really good at, with our analysis, the cycle work that ECRI does and the leading indicator approach at getting the risk of a change in the direction. The structural shifts may impact or do impact. They show up in the magnitude, the size of this overall cycles. In terms of the structural shifts changing the relationships at the cycle turning points, we don't have a lot of evidence of that. And when I say we don't have a lot of evidence of that, I mean over space and time, right? So we have indicators going back to the early 1900s, maybe even earlier, maybe post-Civil War, there's some data, right? And indicators there that we're working at cycle turning points in a structurally very different economy work today in Asia, where there's, like South Korea, right, is a completely different economy than the US post-Civil War. But there are some cycle relationships, leading relationships at turning points that are very robust. So you can have let's stay with the U.S. economy. You go from agrarian to industrial to services. Now we're maybe information services. The cycles are very much there. I think people's focus is on AI or big data or whatever the current kind of cycle is talking about. Services. Hey, I went to the restaurant; it was full. I went to the airport. Like Michael did this morning, and everything was a mess. And so therefore, I must infer something. Really, these big swings in the goods sector are going to overwhelm some softer swing in the services sector. And so therefore, for a directional call, it's important to not get pulled around too much and to have a kind of a consistent process, which we do. And we test that just to finish this, right? So these indicators, the question about kind of when they can fail, right? Does a structural shift make this cycle approach fail? That's the really tough question. And we've figured out where it fails, right? In a managed economy, it'll fail. And we've done that with the USSR. We've done that India pre-90s, and a couple other places. And then where if you're in a truly war-torn economy, so some Middle Eastern economies, when there's a lot of conflict going on, it'll overwhelm the cycle. But other than that, if you're in a free market-oriented economy, doesn't have to be totally clean. So this includes China. These endogenous cyclical patterns are presenting themselves, and that's what we're looking at around cycle risk at the turning points. So when we're looking at forward data, I'm going to give you more than you asked for. Okay, so when you're looking at forward data, where can we go shopping? I'm figuratively speaking. We don't do this very often. We're very set in our ways, but we look for the key drivers of the cycle, and we're looking for sources of information. And so there's government data, and we all know, what that is, and that's one place you can get information for leading indicators. The other is you can go to survey data, soft data, and then you can go to market prices. Those are your options, right? So you can survey data or collect big data, whatever you want to call it, collecting data. So there's private data, there's government data, and there's market prices, and they're all important, and they're all fallible. They all make mistakes. There's a lot of expertise in putting that information together into good leading indexes. Paul Samuelson, a couple of recessions ago, famously said stocks had correctly anticipated, I think, 9 out of the past 5 recessions or something was the quote, I forget. Meaning that, there's information there, but they're maybe a little oversensitive, right? Getting to your point that there's information in market prices and the share prices, the collective wisdom of the market. What Samuelson may not have been aware of is that the other 4, the misses, the oversensitivity of the share prices to the forecasting recession, they all lined up really well with what we call growth rate cycles, accelerations and decelerations in growth. So the share prices were actually doing a really good job of tracking the ebb and flow of economic activity, the upswings and downswings. Just whether or not it was a recession was whether or not it went negative on the downswing. Now, when we look at share prices, we consider them, they're what we would call a short leading indicator of the economy. And they can make mistakes, right? They're fallible. So we've seen 10% or plus rallies. Like right now, you're saying basically defensives. I'm putting words in your mouth, but you were saying defensives are kind of going sideways, and these risk on sectors of the market are perking up. And we've seen 10% plus rallies around the beginning of a lot of recessions, 73, 75, 80, 2001, and even the Great Recession. had that happen. And in particular, I think it was in '01, share prices rallied 19% in 7 weeks inside the recession, at the beginning of the recession anyway. So the share prices can get it wrong where they do pretty well. I mean, share prices do pretty well in sniffing out the end of recession, which is why you have to kind of we have these moments of kind of angst and fear of missing out right now. Is this firming in the share price indicative of the end of recession? That's the real question. And for that, I would just say, hey, you got to just don't look at one thing. Look at the broader good leading indexes. And on that score, I think it's premature to say that there's an end of recession in sight. Maybe some of the long leading indicators might start to get an inkling of it. But remember, we've got to still recognize that maybe we're going into recession. And it's hard for us, the proverbial us, to recognize that until we see jobs growth begin to weaken much more noticeably. I mean, you have seen industrial production go down. You have seen consumption go down. So there are indicators, components, important coincident data that are actually faltering in a recessionary way. It's just that jobs have held up. And so that's how I would kind of, I don't know that in our process, we don't necessarily go into sectors of the S&P and say, this is telling us where the cycle is going. We will look at the overall market prices, share prices, fixed income prices, commodity prices, things, different derivatives of what's going on in there as leading indicators, inputs to our leading indicators. But that's maybe one out of three buckets of indicators that we have. Yeah, look, I mean, policy is a whole different thing, right? So the Fed, I mean, if you've listened to some of my stuff in the past, my mentor Jeffrey Moore was Greenspan's teacher, right? So when we look at different eras of the Fed, or we even think about monetary policy in cycles, right? So they've got this blunt instrument, which is some sort of interest rate / liquidity, and they're trying to. I mean, in theory, they're trying to smooth the cycle out, right? Instead of having big, huge swings, they're trying to have more mellow swings in economic activity. If you believe that free market oriented economies have an ebb and a flow to them, an upswings and downswings in the way that they operate. So in trying to do that, if you think about it, you really want to be preemptive in your policy move. So if the cycle's moving to the upside, you want to kind of gently tap the brakes on the way up, and then when the cycle's on the downside, you want to gently tap the gas. In theory, in order to do that, you have to have some sort of forecast. The most of the Fed's history has been around this Phillips curve stuff, which is tying employment to inflation cycles, and it just hasn't worked. Right? It just doesn't work that well. Greenspan, I think, kind of famously diverged from that stuff. And I would infer, and I'd suggest that he was looking at cycles, right? Because I kind of saw some of the stuff. I knew that he knew stuff that Dr. Moore had been doing. And so from our vantage point, the mid 1990s is hugely different than the story out of Wall Street or wherever else, academia, or even the Fed. I think the Fed has forgotten this. But in early '94, which was up until recently the worst bond market, you had our future inflation gauge, which is a leading indicator of the U.S. inflation cycle. It was ramping up, and Greenspan surprised everybody and started doing rate hikes preemptively before inflation really took off. And then in '95, before inflation really, actual inflation really clearly turned down, he started easing. And from our vantage point, that's hugely important for a long expansion of the 90s. That's a preemptive policy that kind of worked. And you contrast that with what the Fed has done subsequently, and in particular over the last few years, where having messed up as bad as they did in 2018, right? It's ancient history because it's pre-COVID, but in 2018 they screwed up really bad, and as a result of that, they decided, forget it, we're not even going to forecast. We're not even, they ostensibly said, hey, we're walking away from the Phillips curve. We're not going to forecast, and we're going to try to figure out what to do, but we don't know exactly what we're going to do. And that was the setup within which they ran into the inflation cycle upturn post-COVID, which they concluded, they're not really set up to deal with it, that, we think this is just transitory. And you know how that worked out. So here we are. So it's kind of worrisome, I think. If I was going to worry about something, I'm just kind of worried that the policymakers aren't wise to this. And they've got a tool that needs to be used preemptively, but they're really using it reactively. And if something is cyclical and you're reacting to it, you're just exacerbating the cycle.
That is perfectly said, by the way. No, that's phenomenal. Everybody, again, please make sure you follow Lakshman Achuthan here on Twitter. Check out businesscycle.com. I'm doing another space in literally negative 5 minutes.
Go,
with Bob,
Go,
Bob
Michael.
Coleman.
Sorry about
that.
But
no. This is great. Again, this will be an edited podcast. Thank you for joining. And please, everybody, stay tuned for the next one with Bob Coleman very shortly. Thank you, Locke.
Thank you, and thanks for the questions.